Dear participants, the topic of today's discussion is macroeconomics. Business organizations do not operate in vacuum, rather they are surrounded by certain environment, which is normally called external environment. External environment includes political environment, social environment, economic environment, and so on. Today we are going to talk about the economic environment surrounding the business organizations. So we are going to present an overview of macroeconomics. Before understanding macroeconomics, we have to understand the difference between microeconomics and macroeconomics. The word micro means small. So naturally in microeconomics we study economic variables and economic phenomena from small perspective. In macroeconomics we study different economic agents and their activities separately, individually. For example, what consumers are doing, how they demand different products, what is the behavior of producer, how they demand different inputs and they supply different products, what is the behavior of government in a market, what are the different types of market. This is what we study in microeconomics. On the other hand, in macroeconomics we study the whole economy as one unit. The word macro means big, large. So instead of looking into different economic agents separately or individually, we study the whole economy, taking it as one unit, considering it as one unit. This is the difference between microeconomics and macroeconomics. In macroeconomics, normally we are concerned about the overall economic well-being of a nation rather than economic activities of different economic groups or agents like firms, government, consumers, producers, and so on. In modern market economies we face certain questions. For example, how can we achieve high level of economic growth? How can we raise the level of living standard? How can inflation be controlled? How can unemployment be reduced, and so on. So these questions are normally answered in macroeconomics, and in order to answer these questions we have to understand macroeconomic phenomena very clearly. Apart from these questions, we also deal with certain trade-offs or conflicts in our today's economy. For example, if the government wants to achieve high level of economic growth, it may find that the country is experiencing high level of inflation. On the other hand, because of this inflation, if the government takes any anti-inflationary steps, that may result in unemployment, or temporarily the country may experience rate of unemployment which is higher than before. So these questions have to be answered, and these conflicts have to be recognized at the very outset. So in order to deal with these problems, we have certain instruments and certain goals which are normally known as macroeconomic objectives. At this moment we are going to talk about the macroeconomic objectives. Normally there are three macroeconomic objectives which are adopted by governments of different market economies. The very first objective is high level and rapid growth. This is number one or first objective of every economy. Number two is high level of employment with low involuntary unemployment. And third objective is stable prices over a period of time. In order to achieve these objectives, governments can make use of certain tools and instruments. They include monetary policy and fiscal policies. So, a government can use fiscal policy and monetary policy in order to achieve these goals and objectives. With the help of these two policies, I mean monetary policy and fiscal policy, the government can achieve high level of output and economic growth, high level of employment or low level of unemployment, and stable prices over time or low level of inflation. Generally speaking, economists evaluate an economy's performance by looking at certain variables. One of these variables is the level of output, which is normally measured by GDP or GNP. GDP stands for gross domestic product. It means the market value of all goods and services produced by a nation within its boundary in a certain year. On the other hand, GNP stands for gross national product, which include market values of all goods and services produced by nationals of a country regardless of their location in a certain year. So, the GDP and GNP, these two concepts help us to measure the total output produced in a nation. Second, the economic performance can also be measured by looking at the unemployment rate. The rate of unemployment is the percentage of labor force that is unemployed in a nation. When normally output increases, then the demand for labor also increases and unemployment rate decreases. On the other hand, when output falls, then demand for labor also goes down and unemployment increases or rate of unemployment increases. And third is the level of prices or inflation. Sometimes the general price level goes up. We call it inflation, which is normally measured with the help of consumer price index. Now, one thing we have to understand here, the difference between price rise of 2 or 3 products or the general rise in price level. When generally all prices within an economy go up, then we call it inflation. However, if 1 or 2 products prices go up, not all the prices, then we do not call it inflation. To summarize, we can say that the 3 major objectives of macroeconomics are to ensure high level of economic growth and also rapid economic growth, and to ensure high level of employment or low level of unemployment, and 3, stable prices over time or low level of inflation. Now, the government can achieve or can accomplish these goals and objectives with the help of 2 important policies. They are fiscal policies and monetary policies. Fiscal policy means use of government expenditure and taxation. By using government expenditure and taxation, government can affect macroeconomic activities of a nation or macroeconomic performance. For example, by increasing the rate of tax, the government can slow down the inflation, rate of inflation. On the other hand, by reducing tax, the government can encourage business organizations to produce more and thereby to increase the employment. So, it can help reduce unemployment. On the other hand, government expenditure can also be used to affect macroeconomic activities. For example, if the government purchases more and more goods from business organizations, then they will be encouraged to produce more, and when they are encouraged to produce more, they will want to employ more laborers, and it means that rate of employment will increase or rate of unemployment will go down. So, we see that with the help of fiscal policy or by using government expenditure and different rates of tax, the government can affect macroeconomic activities. The second major economic policy which is available to government is monetary policy, which the government conducts through the management of the nation's money, credit and banking system. The government can change the money supply to affect many economic variables, for example, housing prices, stock prices, exchange rate and so on. On the other hand, by changing interest rates, government can also affect these economic variables. For example, if the government wants to encourage business organizations to produce more, it can reduce the rate of interest so that these organizations can go to banks to borrow money more than before, because now the interest rate is lower than the before. When the business organizations borrow more money, it means they can invest more than before, and when they invest more, obviously we can expect that more production in the economy will take place. On the other hand, if the government wants to fight the high rise of inflation or it wants to control the rate of inflation, then it can increase the rate of interest or decrease the money supply. In both the cases, that is either increasing the rate of interest or decreasing the money supply, government can control inflation. So, we see that with the help of fiscal policy and monetary policy, government can achieve macroeconomic objectives. That is why in modern market economies, the government frequently make use of these monetary and fiscal policies. And as business organizations, it is important for us to understand these changes which take place in the economy, because we have to react accordingly. For example, when the government decreases the rate of interest, a business organization can take this opportunity to borrow more money from the bank and to expand their business activities. On the other hand, if government announces a rise in the rate of interest, the business organization has to be cautious about any expansion plan. For example, if a business organization wants to open up a new outlet, it may be unable to borrow more money because of the increase in rate of interest. So, it is important for business organizations or firms to be aware of these macroeconomic policy changes which take place in modern economy. We will now discuss the calculation of GDP or gross domestic product. we have already learned that GDP is the total market value of all goods and services produced within a nation in a certain year. Now, these goods and services which are produced within a nation are normally demanded or bought by different groups within that country or by certain people outside the country. So, we can divide the demanders of these goods and services into 4 different categories. They are consumers, then investors, then the government either at central level or at local level, and foreign buyers or those who are demanding our goods and services from outside the country. So, when we add up all these expenditures by four different groups, we get the total value of GDP. So, this is called, or this method of calculating GDP is called the expenditure method. So, under expenditure approach, we calculate the GDP by adding 4 different elements. Number 1, consumption, which is normally denoted by the letter C. Number 2, investment, which is normally denoted by the letter I. Government expenditure, which is again denoted by G. And number 4, net exports, which is the difference between total export and total import. So, if we add up all these 4 different heads, we end up calculating GDP. Apart from this expenditure approach, we have another approach to calculate the same GDP, which is called incomes approach. If we calculate the measurable income of all individual agents within an economy, we can capture the total value of GDP of a nation. Because if somebody spends $100 or 100 taka, pound, anything to buy a product, part of that money goes to pay the wages to the laborers employed to produce that good. Another part of that same money goes to pay the rents, and yet another part goes to pay the interest, which is basically price of the capital, equipments, machineries employed to produce those goods and services. So, if we can add up all these measurable incomes together, we will find the total value of GDP of a nation. So, if we add wages and salaries, which are normally denoted by the letter W, and interest, which is normally denoted by the letter I, rent, which is normally denoted by the letter R, corporate profits, which is normally denoted by the letter P, and indirect business taxes, and the last, capital consumption allowance or depreciation, then we can get the total value of GDP of a nation. So, we have learned how to calculate GDP of a nation with the help of 2 approaches. One is the expenditure approach, where we add up 4 items: consumption, investment, government expenditure, and net export, which is the difference between export and import. And in income approach, we added all measurable incomes, for example, wages and salaries, interests, rents, profits, then depreciation allowances, all these things to get GDP. Dear participants, we have just now finished our discussion on macroeconomics. It is very important as students of business for all of us to understand these economic phenomena which is taking place around ourselves correctly, so that we can adjust our own internal business policies in line with the macroeconomic changes that are taking place in an economy. I believe that you have understood the concepts, and I think if you go through the relevant lecture in the module, things will be clearer. And yet we have certain textbooks which have been already referred to. You will find it, the name of the book you will find in your course materials, and if there is still any question in your mind, you can consult the book to clarify the issue. And if you can master these issues, I hope that as business students you will be able to understand the complex concepts of economics very easily. Thank you very much.